How Warren Buffett spots those billion-dollar opportunities in brands you literally see every day? Well, a lot of the time it boils down to this super simple three-letter framework. And today, we're going to show you exactly how it works. So to get to the bottom of this, we're diving into two huge multi-billion-dollar bets that Buffett's firm, Berkshire Hathaway, made. And what's even more important is we're going to unpack this simple but super powerful framework that's really driving these big moves. Okay, so at the very heart of this whole thing is this little acronym BGC. It just stands for big, good, and cheap. Think of it like a mental filter, right? It helps you cut through all the market noise to find these really solid companies that are, for whatever reason, trading for less than they should be. This is the exact lens we're going to be using to break down Buffett's latest plays. All right, here's the game plan. We'll kick things off with the BGC framework itself. Then we're going to put it to the test with two case studies, United Health Group and Constellation Brands. And then, of course, we'll wrap it all up with the big takeaways for you. So let's get right into it. First on the docket is United Health Group. You'll see it as UNH. I mean, this company is an absolute behemoth in the U.S. healthcare scene. We're talking about a business that touches millions and millions of lives, both with its insurance plans and all its other health services. So the first question is it big? Oh, yeah, no question. We're talking about a company with a market cap hovering around $275 billion. And get this, its annual revenue is even bigger, a staggering $423 billion. It's a true titan. And it dominates its industry by smartly combining its massive insurance business with its super fast-growing health services arm, Optum. That setup creates this powerful competitive advantage, what investors call a moat, that is just incredibly hard for anyone else to copy. Okay, next question. Is the business good? Well, a great way to measure this is something called return on equity, or ROE. It basically tells you how good a company is at turning shareholders' money into actual profits. And UNH? It's sitting at over 21%. Now that is an exceptionally strong number. It screams highly efficient and profitable business. So yeah, that's a big fat checkmark in the good column. All right, so we've got big and we've got good, but what about cheap? Now, this is where things get really interesting. See, for a long time, UNH traded at a price-to-earnings multiple of about 18. But after its stock price took a hit recently, that number has dropped all the way down to just over 13. What does that tell you? It suggests that even though the company is still incredibly strong, the market has gotten a little gloomy on it, and that can create a really attractive opening for an investor. And that right there is the opportunity. Berkshire Hathaway didn't just talk about it, they put their money where their mouth is, sinking about $1.6 billion into UNH. When a guy like Buffett makes a move that big, it's a massive signal. It says he sees some serious long-term value that pretty much everyone else is missing. Okay, so UNH was a pretty straightforward case, right? Big, good, cheap. Check, check, check. But what happens when a company looks big, but kind of not so good when you first glance at it? Well, that brings us perfectly to our second case study, Constellation Brands. And trust me, even if you don't know the name, you absolutely know their stuff. So first, is it big? Absolutely. Constellation Brands passes this test with flying colors. Why? Because they've built this incredible brand empire. They own the U.S. rights to iconic beers like Corona and Modelo. That gives them this hugely dominant, locked-in position in the American beer market. That kind of brand loyalty, man, that's a massive, long-lasting asset. But this is where the plot thickens. We move on to the good test, and right away, we hit a big old roadblock. You look at their most recent numbers, and the company didn't make money. Nope, it lost $442 million. So that begs a really important question, right? How in the world can a company be good if it's losing that much money? I mean, this is the exact kind of scary headline that makes most investors panic and sell. But for a value investor like Buffett, it's not a runaway signal, it's a dig deeper signal. And guess what? When you actually start digging into why they lost that money, the whole story flips on its head. That huge loss, it had nothing to do with selling beer. It was a one-time accounting thing, a write-down from a totally separate investment they made in the cannabis industry. If you just look at their main business, selling beer, it's still a total cash-generating machine. It's pulling in over $1.2 billion in free cash flow. So yeah, the actual underlying business is still very, very good. And there it is. That scary headline is exactly what created the cheap opportunity. The market freaked out, and the stock price tumbled by 24%. But here's the kicker. Because the core business is still a powerhouse, analysts are looking at this and seeing a potential rebound of over 22%. It's simple, really. The market's fear just put a really great business on sale. And once again, Buffett put his money where his analysis was. Berkshire didn't just sit on their hands. They doubled down, adding a whole lot more to their position. Their total investment is now over $2.2 billion. I mean, this is textbook Buffett, right? Being greedy when everyone else is scared, especially when you're pretty sure that fear is all smoke and mirrors.
So there you have it. We've seen the BGC framework in action with a steady giant like UNH and a misunderstood brand empire like Constellation. So what's the big takeaway? What does all this mean for you as an investor trying to figure out today's market?
Okay, look, you absolutely have to acknowledge the risks. No investment is a sure thing. UNH has to deal with rising healthcare costs and all sorts of political stuff. STZ is facing a market where people are, drinking a little less. But here's the crucial insight, and you gotta get this. Those problems, they aren't a reason to run away. They are the exact reason these awesome companies became cheap. The opportunity only exists because of those problems everyone's so worried about.
And that Constellation Brands example, it's just a masterclass in why you have to look past the headlines. It proves that a big negative number isn't always a giant red flag. Sometimes it's just noise. The real skill here is being able to separate the health of the main core business from all the other stuff, these one-time events or side projects. You really have to understand the story behind the numbers. So here's the blueprint that this whole BGC framework gives you. Step 1, focus on dominant, big companies that are built to last. Step 2, do your homework. Look past those scary headlines and make sure the business is still fundamentally good. And then, step 3, use the market's fear as your signal, your opportunity to buy these great businesses when they get cheap. And if you need any proof that this works, just look at Buffett's own multi-billion-dollar moves. They're the ultimate real-world validation. And really, that's the question at the absolute core of value investing. It's not about trying to perfectly time the market, and it's not about finding some secret, obscure company. It's about having a simple, clear framework to spot quality, and then having the guts to act when fear puts that quality on sale. By using a simple model like BGC, you're just one step closer to finding that answer for yourself.